What's up, guys? I'm Jamie Tajera, and this is your Nerd Report for September 19th, 2022. So let's jump right in and talk about these numbers. I'm Jamie Tajera, co-owner of Property Bear here in Jacksonville, Florida. This is Carrie Hustis, co-owner and sales leader. While Carrie runs all things sales, my day-to-day hunting investments and developments keeps me in two main places. In the field, checking out potential opportunities in construction, or on the computer researching hyperlocal data. So if you're looking for insight on Jacksonville real estate, you've come to the right place. Thanks for checking out our channel, and if you like it, please be sure to subscribe. So the first thing we're going to look at is sales price. We broke down our own numbers, based on price points and our three major counties, and we'll talk about those as we go through them. So right now we've got our median sales price for all of our MLS, anything that basically shows up in it. And of course now it's not pulling up, but so what we're looking at is basically the same thing that we've seen for the past few weeks. It's kind of like barcoding and pricing, trying to figure out where it wants to go. I do think that the Fed is going to tell us where it's going to go, because I don't know if you guys, were looking at the CPI last week and what happened, but basically, inflation came in slightly above where they wanted it to. And, the Fed's been increasing rates this whole time saying, hey, this is going to work. This is going to work. Just trust us. We're going to have a soft landing. Well, that obviously hasn't happened. They've been increasing rates for I don't know how long at this point. And inflation still came in higher than expected. And so what happened next? The SPY dropped, I think, like 4 or 5 points in a day, right? So people are saying, oh, that's being priced in. The, whatever interest rate hike that's coming today, or this week on Wednesday, I think you've got FOMC. And so they're going to tell you what the interest rate hike is going to be. And right now, I think there's an 80% chance that it's 75 basis points, and there's like 18% chance, 20% chance that it's 100. So 100 basis points is 1 full percentage point. So that would drive mortgage rates, credit card rates, everything, 1 point higher, right? Because that's at the cost at which the banks and everybody else is borrowing from. So that's basically what's happening this week. That's going to, push something up or down. Now, keep in mind, the Fed wants higher unemployment, right? Because that helps taper that inflation. I think the unintended consequence, and we've talked about this before, of them using their levers, they kind of overdo it, and it's very slow to pull back or forward or backwards. I think the unintended consequence is, when you look at builders and real estate, they're what, 15-20% of the U.S. economy. Construction jobs, electricians, plumbers, all the trades, like all of these people, right? Well, what ends up happening is, for us right now, you've got everybody that just paid inflated prices and signed inflated invoices, right, 6 months ago to build these houses, right? Because you don't have labor, you don't have materials, you don't have all this stuff. So they signed them, right? They're committed to them 6 months ago. And now these things are going up when prices are starting to taper and potentially go down, right? And things are, not only are actual things more expensive, right? And there's no proof that raising the rates is fixing it. But now also the cost to borrow the money to buy those expensive things is also more expensive, right? And so that translates from credit cards to bananas to home loans to houses. And so we're going to see what's going to happen. We're still thinking that we're going to be looking at a 6 to 10% drop by the end of the year in real estate. And that's our bet. When we're buying houses and all of that stuff, that's what we're looking at. Now, keep in mind, even if we drop that 6 or 10%, we have still appreciated for the year. And that's not even taking into account, the entirety of last year. So let's go into these numbers. Right now we've got our median sales price at 361. We've basically broken the numbers down for three categories: entry-level homes, which are 0 to 400,000, move-up homes 400 to 800,000, and then luxury 800 plus. Um, and we'll go over what those numbers look like, based on what we're looking at. So you can sales price. We're not doing it just because sales price is sales price. Um, so days on market. The days on market that Domus is showing us is 39 days on market, right? So median days on market is 39. So across the board for our entire MLS, we're looking at an increase of 8.5% week over week and 200% pretty much year over year. Now, when we break that down into just Duval, Clay, St. Johns County, and into our brackets, for entry level homes, it's at 37. For move up homes, it's at 40. And for luxury homes, it's at 50. Um, so, yep, your entry level homes are, and I'm going to show you some other numbers that are going to be kind of alarming in a different way, about the days on market and why we separated into these three markets essentially. So median active inventory, you can see that tapering off. Again, I think that's because sellers are realizing that it's kind of a bad idea to sell, because you sell and then you move up to buy. It's not in your best interest. Now, people may not know that. People may not be being educated because they're just watching Instagram. But that's the reality. It's a bad idea to be a move up buyer right now, especially if you bought in the last 2 or 3 years, or even 4 or 5 years. So even more in the 4 or 5 years. So let's look at these numbers. What are we showing? 68, 34. I would look more at the percentages because what I'm going to go over is more based on the percentages. So active inventory across the board went down 0.9%, and it's up 32% year over year. Now, again, breaking down into our three counties, entry level homes active inventory has dropped by almost 3% week over week, and has increased about 4% year over year. Okay, so for the global numbers, that's really high, but for entry level homes in our three county area, entry level homes, there's not a lot of it. We're going to go over that in a little bit. Move up homes, you've got an increase of 1% in active inventory week over week and 85% year over year. And then luxury homes, you've got a drop of about 1% and an increase of about 64% year over year. So again, even though you had a 1 week drop, there's the thing with the luxury homes is there's only like 700 of them active right now. So, your swings are a lot higher. Between the 0 to 400 and 400 to 800, those numbers are more split evenly. It's like 2,200 each. So, but look at those numbers. You've got entry level 0 to 400 only increased year over year 3.7%, and then move up homes, it's up 85%. Here's the thing: if you're in that 400 to $800,000 bracket, you have a ton of competition. It's like if your intent is to take the equity and move up, it's a bad idea. Now, if you are a first time home buyer trying to get into the market, the numbers that I'm kind of showing you it's a warning that right now you have 37 days on market. You have more of an option. This is where the comment about, marry the house, date the rate is actually real, right? Because with the move up homes, it doesn't make sense in the trade off. Now, if you're not trading off and you're just buying a home from 400 to 800 and you're not selling one, you're in a different position. I would, we can have a conversation about renting that property out, buying another one, whatever. But if you're an entry level buyer, here's the thing: just drive around Jacksonville. You're going to see more rental communities, whether it's build to rent single family homes or apartment complexes, than you've ever seen going up ever. A lot of these land deals that are getting done to be build to rent neighborhoods. As an entry level home buyer, you are quietly getting squeezed, and it's going to be harder and harder to get these homes. So if you do want to be a move up buyer later on and build that equity over 5, 10, 15 years, then the best time to buy was 5 years ago. The best time to buy in 5 years will be today, right? So, you've got year over year inventory going up 3.7% is crazy for 0 to $400,000 homes. I know that it can be hard to buy a home right now, but the thing is that your rents in these entry level markets, like not markets, but like in the entry level price point, are going to continuously go up because the numbers are literally showing you that there's not enough of them, and they're not even keeping up with the pace at which like we have people moving to Jacksonville. The other stuff like 400, 800, 85% year over year increase. I mean, that market's gonna take a hit. It's gonna take a hit. Like the math is there. And then the luxury homes at 64% year over year. It is what it is. But at a 3.7% increase, maybe we have people from out of town like buying those middle range and luxury homes, but the entry level homes, the institutions are doubling down and they're buying more of them. So let's move on to the next number, which helps prove my point. Percent of homes purchased with cash. So across the board, you've got these up and down kind of barcoding, but you've got 32% increase, 30%. Wait, 32% of them were cash last week. That's crazy. 1 in 3 homes. That's crazy. Were purchased with cash. I am going to show you a number that is interesting. Week over week, you're up 30%, and then week ending, so year over year, you're down 13%. Okay? Here's the thing. I mean, out of 36%, that's crazy. But here's the thing. Let's go back to our 3 tiers. In the $0 to $400,000 price point, the number of cash sales in the last week went up 40%. 40%. Okay? 400 to 800,000, those cash sales went up 1%. And in the luxury segment, 800 plus, they went down 2.6%. What is that telling you? The entry-level homes from 0 to 400 are being gobbled up by institutions and people that are kind of paying attention. You're not paying attention if you're an entry-level home buyer that's not thinking about buying a house, right? Because you're just not thinking about it. You haven't bought a house yet. It's not on, like, it just isn't what it is. Here's the thing. Right now, there's a window. Rates suck. That's just the reality. They're not terrible historically, but they're just not. It sucks. The thing is, though, is that these rents continue to go up in the entry, in the entry level, right? So almost anything under 400,000, it's kind of a wash, right, from rent to buy. But the thing is that they keep slowly taking chips off the board in that price point, which means that what we just experienced in the last 12 months, as far as there being a squeeze on inventory and prices shooting up, is going to happen again. Because of this like slowdown and the cost to borrow money, builders are going to be slowing down. Our inventory is going to drop. Our inventory is already so down in 0 to 400. It's crazy. It's literally insane. And then on top of that, you see that the number of cash sales went up 40% in a week. This 30% number that you see on the screen is basically made up of everything 0 to 400,000. Everything else doesn't even count. It's like non-existent, right? So my point in that is that we even know the institutional numbers. That's their zone. They're buying houses between $200,000 and $400,000. That's what they want to buy. And if you can get your hands on more of them, I believe there will be another squeeze for inventory for that price point. So I hope that was helpful. If it was, please like and subscribe to our videos, and we'll see you next Monday.